Ladies and gentlemen, I hope you all enjoyed the lunch. So we now move on to the next session of the day. This session will be led by Grant Thornton Bharat LLP, who will provide insights on two critical aspects of the proposed ECL framework. The first theme focuses on approaches to overcome data gaps and challenges related to low default portfolios through the use of proxies, external and internal industry databases, and relevant statistical techniques. The second theme addresses the impact of ECL on capital requirements and the resulting volatility in the profit and loss statement. May I now invite Mr. Jatin Kalra, partner who leads the firm's ECL practice from Grant Thornton Bharat LLP, to begin the presentation, please.
Thank you. Considering this, of course, is our post-lunch session, there's a quick check I want to do with everyone. So how many of you are at least 60% awake? All right, so let's use that 60% wisely, because what we're going to talk about now, of course, is the whole element about data primarily. That's going to be a focus of this session. As all of you know, when we are building ECL models, there are three components which goes in. Data is one big one. You have to look at what data I have, what data I can use, everything. Then you need to have that expertise of how do you use data, build models. And thirdly, you need system infrastructure. How do you host the ECL models and run it period on period. I often joke that building a good ECL model is like creating a very complicated recipe. The regulator wants us to have a gourmet recipe, but half the ingredients are either missing, or you don't know what they mean, or essentially they're expired. So that's the story with ECL models, that the perfect ingredient list, the perfect data list that you may want to have is often not available. And what that means, of course, is that you have to then put that expertise to figure out how do you deal with that situation. That's what we are going to talk about here. It's, of course, something that can go in quite some detail, but we are going to do a relatively high level and cover the more important topics from this theme. So, as you can see here, this is the whole overview in terms of how the ECL numbers get in terms of computed. The first thing, of course, is data prep. So you have data prep for your risk models, your PD, LGD, EAD models, CCF and all. And then you have macroeconomic data which goes in because you have to do forward-looking adjustment as well. First thing to note is the whole RBI directions, draft directions which have come in, what requirements have they put around data? So they've specifically spoken about data, and it's over and above what was given in IFRS 9 and ECL, global ECL also. So it's important to ensure that we understand what RBI wants us to do. One, it says length of data. You always need to have at least 5 years of data when you're using your models. The idea for this, of course, was that they don't want that you use 1 year, 2 year, and that's an outlier year. Let's say you had a very good year, now you're basing your ECL based on that. So we don't do that. You have one economic cycle which gets covered, and they say, okay, 5 years is a reasonably good amount of period which would help cover it. But the fact that they have put in this as a requirement, it says at least 5 years of data. The question that comes is, if I do not have 5 years of data, let's say I have only 3 years of data because the product started only 3 years ago, then what should I do? Am I not allowed to use that 3 years of data and do something completely different? Or is it that is it just to mean that if I have, let's say, at least 5 years of data, then I make sure that I use at least 5 years of data, right? What does it exactly mean? That is not super clear, and that's where some of the people have asked for clarifications also. But generally, of course, the international practice has always been that, 5 years is, of course, what best practice would be, or at least 5 years would be best practice. If I have less data, I still go forward and use it with appropriate adjustments. So I, for example, see that if I have 3 years of data, and the 3 years were, let's say, bad years, then I try to see how the industry performs in a good year, make that calibration adjustments and still use it. But it's not that I, completely go with proxy. But that, of course, is an important thing which, would need to be clarified. Second thing that they've mentioned is that what kind of data adjustments you can do. Now, again, when you do global ECL, globally when you do ECL, what's the thing is that if you have any outlier periods, if you have any anomalies in data, you make adjustments for it so that whatever models are, they are representative of what the future is going to be. RBI said, avoid material inconsistency or cherry picking of data, and you can exclude any data only in case it does not have any material impact on your ECL numbers fundamentally. This is a very new guidance. Only in RBI ECL does this guidance exist. And the reason, of course, was that the whole NBFC experience where they found some instances where people were cherry picking data. They were, for example, excluding data of COVID or stress period or whatever. And here they have put their expectation very clear that you cannot cherry pick data, use the data without adjustments. That again creates some challenges, which we'll talk about, that there are certain situations where honestly data adjustments is very much needed. It is required for us to get to the right models. And then if this guidance is there, how do you go about doing it? So we'll talk about when data adjustments is actually very needed. But that's what the guidance currently is, the regulation of RBI currently is. The third thing they say is that data quality is very important. This falls back to the whole MRM thing also, which they've integrated with this regulation, saying that you need to identify, assess, manage data quality risk. So you have that right process, data validation test, data quality overview, you document any data inconsistency, inaccuracies which are there, how you have addressed it, all of that is a requirement as per the regulation. And finally, it says that, level of data, you need to have borrower level data at a level which is adequate for you to do segmentation appropriately, do analysis appropriately. So that's what RBI honestly has said on ECL when it comes to data. Now, what kind of data typically is needed? There's, of course, a very big list of data requirements that you would typically want to have when you're creating an ECL model. And some of them would be easily available, some a bit more harder. But that's essentially a list. You have loan level data, you have performance data, how different loans have performed in the past, what the DPD was, what kind of write-off was happening, recovery cost, everything. You have customer data, customer demographic, financial related details, macroeconomic data so that you can do forecasting. The first three essentially goes when you're creating your PD, LGD, CCF models, while macroeconomic data you'll want to use for forward-looking adjustments. Some of the challenges we face is that, for example, forecast of MEV, you can have multiple sources providing different forecast. One of the recommendations some people gave to the RBI is that why don't you recommend, okay, what forecast to use? Should I use RBI forecast, IMF forecast, should I use some other source? But currently, of course, if we look at forecast from different sources, it would be different. Also, scenario weights, of course, would be very specific to what kind of portfolio you have, what kind of risk you see in those portfolios. So some of these are a little more challenging than others. Also, what seems to be very clear is that they are specifically looking at integrating EWS, integrating watch list, such kind of accounts, integrating these within your ECL. It was always an implied expectation of ECL that, how you're doing risk assessment internally in the bank gets integrated to your ECL as well. But RBI is a little bit more explicit about it. That, however, is not very simple. Like, okay, you have EWS, you have that data, you have it for, let's say, a few years. But the question is, what in EWS represents a stage 2? How do you integrate the two? How do you create policies on how to use the EWS? So that is a little bit challenging, and of course, where a lot of effort sometimes goes in. You need to have PD and other stuff to be able to do that assessment. Next, for outstanding loans, you need information like what's the amortization schedule in the future, the limit outstanding today, the EIR of the loan. And then you have certain transaction level details like what was the processing fee, transaction cost, and so on. So yeah, quite a lot of data requirements, as you can see. Also, when you start with the whole data journey, the important part is that there might be certain things you may not be able to use, certain data things you may not be able to use. What's also important, we believe, is that documenting how you have concluded it, I'm not going to use it. And very important for this is to look at the annexure A, which is given in the RBI directions, where they've given a list of illustrative information, illustrative data points, which can signify a SICR, which can signify movement from stage 1 to stage 2. And that list in annexure A is very detailed, right? So some of the things that I'll show you, for example, it says, what would be the credit spread if the loan was given today? A loan was given in the past at certain credit spread. If it was given today, would the credit spread be significantly different? If yes, possibly you need to move to stage 2. What would be the terms or covenants, like what would be the LTV requirement for collateral guarantees, etc.? Would that be more if the loan was to be given today as opposed to in the past? Now, you don't keep reassessing it, right? You give a particular loan, unless he comes for a new loan or whatever, you may not necessarily reassess, okay, what's the credit spread of this loan that I would require today, or what kind of collateral, LTV, these things that I would need to be able to approve, sanction a loan today. So these data points generally would not be available for a lot of different instruments which are outstanding today. However, this is what RBI has given in the illustrative data requirement list, and this is taken from IFRS 9. The thing, however, is that now, like in RBI in India for banks, RBI, which is a regulator, provides accounting also. Elsewhere, it's IASB, which is an accounting body and not a regulatory body. Something which a regulatory body provides in a list becomes something where the burden of like us proving that we have actually complied with everything, evaluated everything, is quite high. I mean, we were obviously speaking in one of the previous sessions about something which the Department of Regulation has given, and then the Department of Supervision is going to come in and check whether you have done it appropriately or not. You need to be able to justify that we have actually considered everything which the regulation had, and either complied with or analyzed why we need to or not comply with it. So all of these list of information which is given, a lot of these banks would not use for their staging assessment in their staging policy, but it needs to first be documented, analyzed why we are not using if we are not using something. That becomes another element of task when you're working with data here. So typical data requirements we have just kind of categorized here, the things on which availability would be readily there, and the things which would be complex from an implementation perspective. There are certain things which implementing them would be very difficult, like if I want you to give me PD at origination, it might be very difficult for you to get that number. EWS, again, implementing becomes difficult because how do you integrate it with your staging policy? So yeah, quite a lot of data requirements. Again, we are not going into each and every element of it, just to give you a high-level overview of the kind of requirements which are there, and typically they range between how complex it would be and what the data availability would be. What we are going to use our time more is to talk about some specific scenarios which we see most commonly, where data challenges come in and how people sometimes debate on how do you deal with it. So our experience with data. I want to start this section by asking you a question, right? And the question is this: what do you think is the answer to this question? So farmer has 15 cows, 7 of them ran away. How many cows are ready to work the next morning? Insufficient data. Anyone has answer to this? Yes. So the answer to this actually could be anything between 0 to 15 or possibly more. And it's very rightly said that, just by this fact set that I've given, probably it's impossible to get the answer. You may say it's 8, but then I can say, no, it's not 8, because actually 2 of them came back. So it's actually 10, right? So it can actually change. And that's what we see when we deal with data also. So I'll tell you a few real life stories that we have dealt with. There was this client of ours where we asked him that, okay, I need DPD information of all my customers for the last 5 years, right? All my accounts, DPD information, last 5 years. They said, sure, we of course maintain DPD. We have DPD, we'll give it to you. 3 days later, we get the DPD information. Everything looked fine until we checked in consecutive months, how much does the DPD increase, right? So for example, let's say March 2024 to April 2024. How much did the DPD increase? Generally, it should be up to 30 days maximum because 30 days it can increase. We saw that the DPD increase between months was ranging from 0 to 450 days. So there are certain months in which DPD increase of a loan was like up till 450 days. Why did it happen? It was because of certain restructured account moving from here, DPD freezing, all of these things. So the point that we realize, of course, then is that we'll have to deal with these things because if you create models simply based on a DPD data which we have, it's not going to work out. I'll give you another example. We had this scenario where we asked a bank, okay, can you give us processing fee data of your loans for the last 5 years, right? Because I need to do EIR. EIR is required for ECL. So give me processing fee that you have earned over the last 5 years. They said, sure. They gave me a spreadsheet. It had 5 rows. Each row was processing fee for each year. For each of the last 5 years, they had given the total number of processing fee earned. No loan level breakdown, right? No instrument level breakdown, nothing available. So again, data is there, but honestly, if you look into it, it's not adequate. There was another, we were doing this discussion on staging, right? Stage 1 to stage 2, when do you move? So management said, we believe our behavioral scorecard is very important. That is the best way in which you can see any changes in credit risk. And you should definitely use your behavioral scorecard. You should definitely use my behavioral scores of my customers to assess this change in credit risk. We said, fine, give us the data. They provided the data. We identified that for 47% of the loans, there was no behavioral scores, right? So again, we found that possibly now we cannot use behavioral score. If for 47% of my population, that metric is not available. So while ideally we may want to, the reality is that we may not be able to. So, these are some of the data challenges which are there, which once you start evaluating data, running it through, what purpose you have, what use you have, availability and consistency and accuracy and so many different things, it goes through a process and you'll see that there are a lot of things which are there. But it, of course, is an extremely, extremely important process to go through also, because we have also had scenarios where people have created models based on certain data. 2 years, 3 years later, some mistakes were found in the data, and then they identified, oh, we should have corrected it when we created the model, and it got missed out. And it gets missed out by us also, honestly speaking, while we would have done, 75, 80 clients now doing ECL models. Still, today also it happens that sometimes we create something and then we realize, oh, this got missed out. So data evaluation is something which is an extremely important step before you move forward in terms of putting into the model. So that was on, cleanliness of data, that was on hygiene of data and the whole issues around it. The other thing which becomes important is, when can you adjust data? If you have scenarios where adjustment is necessary, can you do it? How can you do it? I'll give you a few examples here. One question that comes up very, very often is the whole issue that, okay, I've changed my underwriting at some point. I've strengthened, tightened it. So now I only give loans to better quality customers. In the past, I was giving loans to poor customers also, or poorer. But now I'm giving loans only to good quality customers. Let's say in 2023, I had this regime change. I've tightened my scores to whom I'm approving loans. I've tightened, let's say, LTV or something, and things are better now. So I've had this regime change, underwriting change. Question is, this happened in 2023, let's say. In this example, I've said 22, let's say. So, okay, 22, this happens. At post 22, I have a different underwriting. Before, I had different. Now, RBI says, use 5 years of data. My submission is, if I use 5 years of data, let's say I'm in 25, so 3 years of data would be with the new underwriting principles. 2 years of data would be wrong underwriting, or wrongly incorrect or outdated, or the prior thing that I had. And then, of course, what should I do? Should I still go forward and use 5 years of data? Straight lines say that average is this. Let's say for the first 2 years, my average loss was 3%. Remaining 3 years, it's 2%. Should I average the two? Or should I say, no, post regime change, the 2% which is there for the last 3 years, that 2% is more representative because that are the loans I'm giving now, or those are loans which are existing today. I'll go with that. What do you think I should do? In context of what is given in the RBI regulation of using at least 5 years of data. What do you think I can do? What options do I have? Any thoughts on this?
See, when we are moving from rule-based to principle-based approach, this kind of assumptions will be tested.
This kind of, sorry, I'm not able to hear very well. Yeah.
Kind of assumption in this kind of situation, no, it will be tested by regulatory, by supervisory review.
Yes.
Then only it will be decided. It may be whatever SSM thinks for our bank may not be the same thought in our bank. So I think supervisory review process will set this standardization. Till that time, this kind of debate can go on.
Yeah. No, which can take ages, of course.
I can
which
take, but
create a lot of-
but better is that we can take a conservative call.
Okay.
That to some extent will help us to effectively reply to the RBI's requirement.
No, it's very interesting that we are saying that it would be good to take a conservative call because of the uncertainty which is there in terms of how the supervisory, team would essentially end up opining on something like this. That is quite interesting. Any other thoughts that in this situation, what do you think should be done? Okay.
Relevant, so no point in using that. Which we feel is relevant, that only should be used. It can be a low, in terms of amount of data can be low, but that model can be developed for that kind of data set.
Okay.
I think we should take from the point where this rule engine was tightened. So that will be more realistic to
Okay.
go.
So you're saying take
have
only
forward.
post 2022 in my example, only post that, not prior to that. Okay. So one is that remove the prior data. Any other thoughts on what can be done? Yes.
Maybe we can see if there's any relation between the older
Okay. Very interesting. Okay.
regime and new regime, and to that extent have some weights.
Can you elaborate on that? How do you link and find relationship?
So typically, if I'm saying I used to lend to earlier to a triple B, and now I am lending at a credit spread of X.
Okay.
Now I am lending to only to double A, but the credit spread is X minus something. So now the triple B which I am lending, if I am lending to one, what will be the credit spread in the new regime versus the old regime? And that can be an indicator of the spread.
Okay. Very interesting. Very interesting. Any other thoughts? Anyone has any other ideas of dealing with this situation? Yes. Oh, very interesting. Very interesting. You're saying let us evaluate. That's actually very interesting. Yeah. Yes. 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 So the views that I've got heard, I can categorize into two buckets. One, some people are saying let's use only post regime change, right? Before is no longer relevant, no longer useful. Ignore the data. Use only post regime change. Second, what we see is, what we hear is, include the prior period data also, but try to see how do you relate it, how do you adjust it appropriately so that we can get it. And how we look at it is, there are few adjustments possible. One of them is, can we look at sub-segmentation in the previous data? Let's say previously we gave data to customers for whom credit scores, let's say, ranged from 0 to 100, right? Now we are giving loans only to customers who are ranging from 20 to 100, right? So we are not giving to 0 to 20 wala bucket. So maybe what we can do is, the performance of loans which are in 0 to 20 bucket, which is not there anymore post a regime change, we remove that part of the data from the earlier data set, keep the remaining ones, right? Which is, in a way, similar to what you had suggested, that okay, historical data you see, how would that go in the new regime? Similarly, what you mentioned, can we create a linkage between some underlying variables and then try to create results by calibrating those variables so that you can do a like-for-like comparison by calibrating and equating those variables before and after. That is another way of calibrating, adjusting data to get that. So these are two solutions. One, remove the data completely. Second, adjust, calibrate the data to make it in line. And the third possibility is that we don't do any adjustments. When would that be correct? If the change in your PD is actually not because of a real change in underwriting, right? It's only honestly because the economic conditions have moved in a way that performance of customers has deteriorated or increased or improved or whatever. So what is extremely important for you to be able to identify when is it that such recalibration or adjustments is needed is for us to keep track of movements like these if they have happened. Like for example here, what we have done is origination scores of customers before and after. We can see that it is different. Pre-2022, the yellow chart is much to the left as compared to post-2022. So we can see regime change playing out in data of origination scores also. I'm assuming here that the scorecard remained the same. If it changed, then it can add more complexity. But that is the first thing which is also very important, that we keep track of any changes which are there in the data, any regime changes which have happened. And if so, then we consider these alternates of either removing that data set, adjusting it, or keeping it as is. Now with the whole RBI directions, while these three alternate solutions are the ones which globally are considered in such a scenario, in India, of course, with the RBI restricting that you have to use 5 years of data, I would probably say that the first solution, which is of removing the prior data set, would probably not be the wisest. At this moment, it's more appropriate to consider how you can adjust the prior period data, bring it in line, make it more appropriate for the current type of portfolio. So yeah, action required, detect distribution shifts as they're happening in the data so that you know when you need to make such kind of decisions, such kind of adjustments. Apply data adjustments like either you retrain based on new data, either you recalibrate, you segment models like I mentioned, or you create expert overlays if needed. The other thing which we often see as one of the complexities is outlier periods. Let's say your underwriting, everything remains same, there's no regime change, but there was a certain period which was extreme shock event, blue swan, something like that happened. COVID is an example, right? Because of that, we have certain part of the data which is actually very different from other parts. Now, what do I do with this? Question is, what do I do if I have, extreme shock events, outlier data? What should I do with this? What do you think could be options for us? Okay. Okay. Excluding is one option. Any other options anyone can think of? Extreme shock event has happened. What should I do? Keep it. Keep it is another option, of course. That's a default option. Do nothing. Exclude is one option. And the third option, of course, is we keep it, but with appropriate adjustments. So this is, in a way, similar to the regime change thing. The way to detect it is, of course, different. Generally, how regime changes are detected is by looking at the parameters and any change in the parameters. How an outlier period is detected is by looking at the default rates or LGDs or whatever you're identifying it on and trying to see if they are beyond a particular range. It's very common to do monitoring like a IQR range or something, just to see that anything that goes above or below a certain threshold of IQR, interquartile range, is something which is an outlier. And statistically, that is something which becomes eligible for adjustments. What kind of adjustments are possible? There are quite a lot of them. You can do capping, flooring of that. You can do, calibration in terms of, that. You can do down weighting of it also. There are certain periods, okay. Like COVID can create such a massive shock. It can, average default rate, which is, let's say, 3%, it can make it 9%, or 3 times the loss. COVID can do that. But what's the probability of COVID happening in the future? Maybe it's 5%. So that period, that loss rate, weightage of that is 5%, while weightage of the other scenarios, which are more normal, is 95%. So you can downweight in terms of adjusting for it. So those are some of the options which are there. The thing which RBI, I believe, particularly did not like is that some of the NBFCs actually removed the entire data set without doing this assessment, without essentially considering if we should create multiple scenario downweight, whether it should be that we should do capping flooring, whether it is that, and then it was like, okay, it opens up a Pandora box. If we give people the opportunity to remove data, right, cherry pick data, it opens up a Pandora box and then there's no control. So they are like, okay, easiest option, restrict on this. But yeah,
does it assigning a probability to that event itself again become questionable? You can assign 5, I can assign 1, someone can assign 0.1% probability.
Correct.
So
no, it is subjective. How do you bring that probability of COVID happening in the future, right?
No, you're talking about RBI not liking it. RBI may not like it at any situation actually.
Correct.
My assigning 5% also they may not like. My assigning 0.1% also they may not like.
Yeah.
Yes,
So you are right. I mean, there's definitely, I'll give it to you, a lot of unpredictability on how some of the policies or some of the practices or modeling choices are going to be. And that was one of the points mentioned also, that when the reviews happen, then only some of these things would actually get stabilized, and it would take years to stabilize. That is definitely very true. So yeah, at this moment, what we can do is whatever best is possible, but there definitely in a subject like this, there will be some uncertainty which would remain and some potential of risk. Now, how do you best address that risk? One, of course, if, for example, I'm giving a probability of 5% to do this, because I know that if I don't do it, it would completely give me unreasonable results, and that is also not fair, right? Trying to analyze, like, what's the probability of a black swan event, trying to analyze what, historical data, if we look at globally in India, whatever, when is it that such shocks happen? Is it 1 in 25 years, 1 in 15 years, 1 in 20 years? There are studies which explore such kind of things, trying to do all of it and make sure that there's good documentation, there's good approval, governance, everything. So it's not something that someone is doing without really getting all the approvals. I think doing all of that is something which can help justify later. But yeah, there would be some inherent element of risk which would be there. And then, of course, the alternatives, we go completely conservative if you want to avoid it, which may not be completely practical also. Yes. Some of the things that we found potentially can be also done is, for example, the default rate in COVID was something, if you look at DPTs and everything, but if you make certain adjustments like morat adjustments or certain kind of loans which actually recovered over a period, give them longer period, all of those things, then, the default rates are a little more streamlined. Now, with this, I think one of the curiosity that you might have is, COVID, of course, happened when ECL was already in place for a lot of banks internationally, right? So how did international banks consider something like an outlier period like COVID, right? That can give some perspective. So this is a study of European banks and how did they address COVID-related data when they are creating models today. So 9 out of them, they are, I think, close to 35 if I'm not wrong, 9 out of them said that we have reflected in the reference data set without making any adjustments, right? So 9 is pure data without adjustment. That's what they did. 6 of them said that we have reflected in the reference data set, but we have done adjustments to remove the effects which were not deemed relevant for future contractual cash flow. So these are inclusion with adjustments, 6 of them. 6 of them completely removed it from the data set. So 6 European banks completely removed COVID data from their data set. That's what they said. Then another 6 are saying that we have not reflected an historical data set, but we have created certain scenarios with certain overlays to incorporate the fact that something like this can happen in the future, right? So that's 6. And then there were 9 who said other things, but yeah. So you can see very much a mixed field, right? There's some which are including without adjustment, some including with adjustment, some excluding completely, some incorporating in the scenario. Completely mixed field. And there's something which was done by EBA, European Banking Authority. In 2023, their monitoring report essentially summarized some of these findings. So this is of course one which is COVID. In India, every year, every second year, you'll have some or the other reasons where this debate is going to open up. Can I do adjustment for this? Can I remove this data? We have of course MFI related stress which is there. A lot of MFIs are debating, is it representative to me? There was, you'll have flood, you'll have election, you'll have some or the other thing somewhere happening. And because of which these questions come in. There's also one debate that we often have, which is, let's say I as a bank had certain fraud cases, right? There were certain defaults because incorrect loans were given, like underwriting was done, which was inappropriate. So let's say there's 2%, 3%, which is my default, which has happened, which is actually because of incorrect loans. So there was fraud. And that was because, let's say, certain people were like that, or certain branch was like that, or whatever. There was some issue isolated. And now I have addressed it, right? Now I don't anticipate fraud defaults like those. Now what do? That branch data, or that loans which I can clearly identify was underwritten inappropriately, they were approved or they were given at a certain rating which they should not have. Those loans ka data, should I remove? Or no, I'm not able to do it. One argument is, it is not representative, right? Because I'm not doing those kind of things anymore. It's not representative, let me remove. Another is, it's part of the business risk, I'll keep. Clear the question that I'm asking? Now, how many of you think that I should keep this data? Like even if there's been some fraud in some branch or some product or some type of customers which has created defaults, I still keep the data. How many of you think that?
Depends on like whether that data is outliers. So I say suppose the kind of impact that fraud has happened, say like 10% of my total profitability gone. Like this is a kind of outlier event again,
Yeah.
right? But this is a normal business course. The fraud keep on happening. Say like it has some kind of impact, say up to a certain percent of it. So then we should keep it, but we need to identify whether it is an outlier event or not.
Okay. Let's say it is an outlier event. I'll,
So then again, probably we need to assign a probability, as you said earlier.
Okay. So there are few of you who raised their hands by saying that it should not be removed. How many of you think that it should be removed because it's, a risk which is not expected to be there in the future, because I have already fired those employees, or I have already taken care of that branch or that product where the inappropriate things were happening? How many of you think the data should be completely removed? Any of you think data should be removed? Okay. Few hands I can see got raised, but not many. And it is definitely, a question which comes up and creates a lot of controversy. I'll give you the pure technical answer first. Pure technical answer says that if there are certain data points, there are certain defaults which are because of things which you are sure is not there now, right? You have done the cleanup, it's not there now, you can safely remove the data, right? If it is something because of an outlier period, because there was some stress which was there somewhere, then you do, mostly you do the adjustments or you do the scenario weights and these kind of things. So that's what basically it says, like operational frauds and these kind of things, typically you are allowed to remove from a pure technical, theoretical perspective. Having said that, it is I mean, it's a very much a judgment call, and there are differences which still exist. So yeah, every case needs to be looked at, and then it needs to be concluded. What do you do? But anyways, if you do end up removing, you have to defend it. Why you're not cherry picking? Is it that certain segment is removed which is not there? It's a different segmentation you have done. You have not really cherry picked. What kind of approvals are required? How do you handle these exclusion macro model, and so on? If you keep with adjustment, what kind of adjustments you do? And lastly, if I keep the data without any adjustments, questions come, is it overstating ECL, my peer benchmarking, my impact on backtesting? These questions you'll have to address. So any choice you take, there are some good complex questions which come up, which you need to address. Okay, the third thing from a data perspective is, what if I don't have data, right? It's a low default portfolio, I do not have data, what do I do in that case? It is a scenario which comes up reasonably often, so we'll talk about few of the solutions which are available. The first one is we end up using an external proxy data. The second is internal proxy. Then there are certain statistical techniques, and finally some of the other approaches. So if I talk about external proxy, what is very common, not very common but reasonably common, in some of the foreign banks is using data from global credit data database. Anyone here who knows what global credit database is? So there's this, you can do this, global credit data on Google also. There's this not-for-profit organization, which is essentially a pool of banks, which is a group of banks, which goes by this principle of sharing data to be able to get data. So anonymized data they share of how their portfolio performed, and then aggregated data they get access to. So for example, one of the large foreign banks here, their parent company uses global credit data when they do not have data of their own to be able to create their own thing. The problem, however, is global credit data, there are no Indian banks on this, while almost most large foreign banks are there on that platform, and they are able to get access to it. So for example, let's say I'm doing auto loans now only, but other people have done it, so I can say, okay, auto loans performance, how it is in similar kind of banks and similar portfolio. But Indian banks do not have access to it at the moment. So that is a challenge. Maybe in the future we have such pooling of data which can help all banks in a similar way. But currently we do not. So what that means is, if we look at external proxy data, the sources are limited to data from rating agency, which at a rating level they give, okay, what's the observed default rate. There are certain bureaus which also give at score band level what kind of default rates do you have. And then you do appropriate mapping of that credit score, credit rating with your customer, so that you are able to then essentially identify that what it would be. One more thing is, there are certain rating agencies who would come in and give you heuristic estimates, who would give in their judgment that, okay, I'll assess your portfolio and I'll say that based on my experience, what kind of risk would be there on this. So that is another possibility which is there. That's on external proxy data. There aren't any very good study reports which have been done on Indian data. There are some, but they are not considered very usable. So currently, there are no study reports, research on Indian data set, which can give you PDLGD by product, which would be very useful. The other possibility is using internal proxy data, aggregating some of the risk rating levels so that you have adequate data, or combining internal segments with similar risk characteristics. So this modeling you can do in a way that helps a bit more. There are some statistical techniques also. Pluto-Rash model is one which can help you in a low default portfolio setting. BCR again is another technique which can be used. If you have very little defaults, BCR can be used. So there are some of these statistical techniques also. Otherwise, some of the other approaches what we sometimes follow is, let's say I have very recent portfolio. I can reasonably get 3 months or 6 month probability of default. So I calculate that and then I extrapolate it to 12 month or beyond by doing, let's say, a Markov chain or some, some kind of extrapolation I do. That's one in terms of creating horizons which are smaller, so that you are then. Another thing which sometimes we do is that, okay, instead of using 90 TPT, let me use 30 TPT rate and calculate probability of default by probability of 30 TPT, and then I make appropriate calibration adjustments after creating a model to bring it more in terms of what the PD should be. So yeah, these are some of the options from a low default portfolio perspective. One interesting and very important element to highlight here also is that RBI has given certain proxies, right? Especially for LGD, it's most noteworthy, where they have mentioned that, okay, 65% for secured, 70 unsecured, and if you have eligible collateral, then they have prescribed the proxies. Question is, let's say, and they have also said that you need 5 years of data to create your models. My question to you is, let's say I do not have 5 years of data, right? But in my portfolio, I know that because of the nature of collateral guarantee, everything, let's say I have housing loan, right? Typically in housing loan, let's say the LGD I know in the market is, let's say 20, 25, 30%, not more than that. But if I use RBI proxy, it says 65% for a secured portfolio also. So what do I do? Because I do not have internal data, I am automatically to apply 65%, which is a proxy given by RBI in their draft directions, or do I still have an option to apply other proxies which are probably more appropriate for the particular product which I have? That is another, question which is there in a lot of institutions' mind, and where feedback, of course, has been requested from the RBI. In other regulations, of course, you do not have these proxies prescribed by a regulator, so people do whatever is most suitable in their scenario. In our case, it becomes a bit of a question. Perfect. So these are some of the data-related challenges, issues which are there. Any questions at this point on the discussions that we have had so far? Yes.
Great presentation, thank you. So in your data requirement, in that portion you said we need loan data, loan performance data, customer data, and then macroeconomic data. So this is a volatile environment, right? So getting this macroeconomic forward-looking indicators is highly unpredictable. So how would you calibrate this overlays?
How would you deal with that? So that brings us to a very important element on which data again is often inadequate, which is macroeconomic data, and forecast particularly may not be at that level with the disaggregation which you would want, right? Let's say I'm trying to create a model on MFI loans which I've given in the state of Karnataka, right? Now, what's macroeconomic variable can I use to predict how performance would be for these MFI customers in this particular state, right? You would say, okay, which ones are available in India? Very limited ones. You have, of course, inflation at a national level. You have GDP at a national level. You would possibly have some forecast of unemployment, interest rate. Some of these variables you do have some forecast for, but you will say that, my portfolio is so, specific that these general forecasts which are at a country level, they're not really giving me any usable output. Then what should I do? That often becomes one of the challenges when we are doing modeling, that the information which is available, the forecast, macro forecasts which are available are so general, so broad that they do not fit to my portfolio and my performance. What do I do in these scenarios? See, there are two options. Option one is that instead of creating the model based on my historical data and the macroeconomic variable, so my PD and let's say GDP, I try to see if I do a industry level data, industry level MFI data, industry level home loan default data or whatever, and then try to create a model. Is correlation good then, right? Possibly my history is a bit limited and therefore I'm not getting relationship. But if I look at industry level, MFI versus GDP, MFI versus unemployment, MFI versus inflation, then I'm able to get good relationships. And then what you can do is you can use the industry level data instead of your own historical PD while creating the macro models. Right? That is one of the options which a lot of people generally use when you face such scenarios. So you get a multiplier, you say that, okay, next year MFI industry, I predict it's going to be 10% worse than general TTC estimate. So then I apply 10% worse estimate for my historical PD. That's one, that you aggregate the default data at an industry level for the same product, make sure it's similar, and then create model based on that. Let's say that is also not happening, right? You're not able to use industry level data also and get appropriate results. Then you have two options. One is that you create appropriate adjustments, overlays and all, right? And that becomes quite complex, that you have to actually create scenarios, predicting what would happen based on your own judgment and everything. And then say that, okay, based on this is the 10% good then normal, 20% good then normal, 30% good then normal year, 10% bad then normal year, 20% bad then normal year. Like where in the range is the next year supposed to be? And accordingly you calibrate the estimate up or down based on how your prediction of the next year is going to be for that portfolio based on your consolidated evaluation of all the qualitative, quantitative information which may be available. Now this would not be modeled, like that percentage is not something we will get through a model, and it would be more a mix of some mathematics, some statistics, some judgment. But then, that's the thing which otherwise people have to do. And then, make appropriate adjustments with overlays and stuff. There are other models which are standardized models like Vasicek model, where technically, you don't need to prove correlation on historical data and still use. Some people do use it, but what we are seeing is that, it's going to become more and more difficult to prove something like Vasicek model is appropriate. Standardized models like Vasicek model is appropriate without doing all of this analysis. So, yeah, I mean, it is challenging, but those are some of the options which are there. There are some other statistical techniques also which, are available, but yeah, I mean, whatever you look at it would involve judgment.
Helpful, thank you.
Any other questions on
You just
the
spoke
data?
about that Vasicek model. So why it becomes such a preferred choice? Like being very simple.
Simplicity.
Okay.
Simplicity
So like
is
at one point we talk about simplicity, but at the same time,
Yeah.
that simplicity itself become a problem
Yeah.
as well.
So Vasicek is completely simple. It's like it's like 10th grade mathematics, honestly, right? And what we're talking about here is PhD level statistics, and that's 10th grade mathematics. So it's very, very simple to do Vasicek. And I'm not saying it's wrong to do it, but some institutions, how it was done, it got identified in monitoring that it was not appropriate. So let's say in Vasicek model, if you let's say predicted, okay, my PD is going to be 20% lower, and ultimately the next year you identify the PD were 10% higher, then it would be questioned that why such a big gap. So one can still go forward use Vasicek, but it would be important to consider which variables you are using. Is it appropriate? Is it something you can test with own or industry level data, right? What scenarios, what final outcome you're getting, benchmarking or doing a corroborating, check against the final outcome which you're getting so that everything's sensible, like at the end of it. Also, like I was mentioning, when we talk about macro, a lot of people use Vasicek because they're saying, okay, my macro models based on, let's say, regression or some statistics, it's not giving me the right answer, right? I'm not getting correlation, I'm not getting a model. The thing is, you can do that only after exploring it appropriately. And when we talk about macro models, there are so many variations possible. Like you can do, multivariate models, you can do combinations in different things, you can do PCA to, help in some of these things. there's a lot of transformation you can do to variables. You can lag it, you can, bound it, you can adjust for outliers. Like there's a lot of statistics possible while doing the regression type analysis. And only if you have done all of it and then concluded nothing's possible, then you go to Vasisek, it's still going to be okay. But people are jumping to that final outcome without doing analysis. That is where questions then, are a little bit more prominent. Any other questions before I move forward? There are a few slides, so I need 5 more minutes, but any other questions on this topic, then I can.
Yeah, just one. On the low default portfolio, so you've suggested methods for, say, PD estimation. For low default portfolios, how do we handle LGD?
Sorry, which side? Can you raise your hand also? Okay, thanks. Okay, so LDP, PD, we have addressed. LDP, LGD, how do you do, right? I think some of these things are actually relevant for LGDs also. So example, I gave you, one scenario where people are using global credit data. So global credit data gives you PD and LGD information. And that institution was actually using only for LGD because PD, they are saying, I have my own. Similarly, heuristic estimates are quite common when you talk about LGD. It is, what we have seen is that, okay, if I have portfolio where it's secured by power plant or projects or whatever, then I do estimation that, okay, is it a plant with PPA? If so, what haircut would be? Is it a plant which is under construction? If so, what haircut would be? So creating those estimates based on judgment, heuristic estimates based on assessment and everything. You do valuation of collateral, apply appropriate haircuts. Those are some of the techniques which are available. But the thing is, the question which comes is, in the draft direction, it says you apply 65, 70% LGDs if you cannot reliably estimate your own, right? The question comes, can you even do all of those things to get a more appropriate number? Or is it that if you cannot estimate based on own data, you have to apply the RBI prescribed proxies only, right? So that question comes in, and that question sometimes becomes more important when the difference is very large, right? For wholesale, whatever, I mean, the answers, but certain kind of portfolios, it might be that actual LGD is only 20%, this is like 65, massive difference. So should I still do 65, right? And the other way around also, let's say actually it should be 80, 85 because, it's completely unsecured, whatever. Let's say unsecured PL or something, and, maybe it's 80 and then should I still do 70? So if the difference is large, should I still do proxy becomes a question. Yeah, so on LGD also you then go and have the similar analysis. All right, so there's one thing which, first of all, of course, thanks for IBA to organize all of this and, having this conversation. There's one thing which we discuss is that there's, if you want to do an assessment of your model maturity, like where you are in terms of the whole journey, different aspects, PD, LGD, staging, SICR, everything, how mature our models are, you can make use of a complementary license which is there of the tool that we have, which actually helps you do this assessment, get your results in terms of assessment scores, and also help identify which are the issues which may require, analysis evaluation. So we'll give you the QR, you can scan this, and the team would then connect with you in terms of helping you do this assessment. That was on data. There's also brief discussion, a very, very teaser type discussion that we wanted to do on volatility, because we were addressing even at lunch, some of you asked this question on how do you deal with volatility. And while of course we do not have a lot of time here, we'll want to give a teaser on this. So first question on volatility which is there, and it's a big question, like a lot of studies have shown that volatility has significantly increased post ECL, right? Studies which have been done by people associated with the EBA, other researchers, they found significant volatility. Like for example, when COVID happened, immediately when COVID hit, there was a significant jump in provisions. Although a few quarters later, a lot of them had to reverse it also because, the COVID related, whatever the worst case scenario, or the scenario under which provisions were created, didn't actually turn out because of whatever reasons. So they had to reverse some of them. Some actually rebranded and created other overlays. But yeah, it created a lot of volatility, decrease in provisions, which were much, much, much sharper than anything you would do otherwise. So what's the reason for volatility and how best to get it addressed? The first reason is when movements happen from stage 1 to stage 2, because you directly move from 12-month provision to lifetime provision, creates a lot of volatility. Second one is the forward-looking adjustments, like COVID is an example of forward-looking adjustment. You immediately look at some bad or good case. So you have to adjust it. The forecast scenario, when they change, creates a lot of volatility. The worst thing about this is sometimes you get to know about this much later, like the forecast, GDP forecast, for example, it gets revised quite sharply, right? In India also, you would have seen sometimes upward, sometimes downward. So you end up realizing that, okay, now my ECL numbers are going to be quite different because my model's on GDP and my GDP forecast has changed. If there's portfolio mix which has shift, there are new originations runoff which has happened, it can create volatility. And finally, but also quite importantly, regulator and auditor interpretation changes, and that creates volatility as well, right? So ECL, however, is not, it is kind of designed for volatility in the sense that they are saying, okay, volatility is good. You would want ECL numbers to be reflective of the current situation, the forecast and everything. So they would say, okay, volatility is desirable, but what organizations need to do is try to remove, undesirable volatility, like volatility that comes because of an auditor interpretation changing, a regulator changing, volatility because of, you're not planning enough well in time. Those kind of things is something which is a little bit more avoidable. So yeah, it is a fact that volatility is there, but it's also a question that requires a lot of analysis still and a lot of effort just to make sure that we do not fall victim to undesirable volatility. So that was what it is. There's a lot that can be discussed further on this topic, but with limited time, we wanted to end here. If there are any, is there any time for questions?
We can take maybe one question.
Okay, if there's any question, we can take quickly. Otherwise, of course, we'll move on.
Sir, there is one provision in this this draft ECL guidelines that going forward that as a runway to the preparation for the ECL and to mitigate the volatility, the banks can create the floating provisions and subsequently it can be offset when the ECL framework is in place.
Okay.
Is that right? Apart from the floating provisions, are there some guidelines specifically for the setup of the do you think that floating provisions will be continued or it will be subsumed as a part of the ECL from the as the other provisions are there, provisions on the standard assets and provisions on the NPA?
Yeah. No, what you have actually referred to is a very practical tool people are using for managing volatility. And there's a name for this tool. It's called management overlays, right? So if we are being very frank, and some of, it's of course for valid reasons often. Basically, what you're saying, floating provisions or these things, in ECL also you have non-modeled ECL, right? There's one model ECL which is, let's say, 10 crores. Then I create another 2 crores, which is non-modeled, as a management overlay. And what this can actually end up doing is, at a later point when there's something which becomes a problem because of which I am to increase my model risk from 10 to, let's say, 11, I already have 2 crores additional. So I'll say that, okay, I'm releasing 1 crore from management overlay and putting it in the model ECL, right? So yeah, be it floating provision, be it management overlay, it is there. But again, what the regulator expects and what the auditor also expects is that any overlay you create or any overlay that you release should be for valid, genuine reasons only. It should not be to manage volatility. Yeah, perfect. So thanks, everyone. We'll continue the next session now.
Thank you, sir. Please be on the stage for a moment. Yeah, thank you very much for the detailed presentation, sir, sharing some actual scenarios and some global approaches as well. May I invite DC sir to present a memento to sir as a token of our gratitude. Thank you, sir. Thank you. Ladies and gentlemen, please be with us while we set up the stage for the next session. Gentlemen, we now move to the final knowledge segment of today's program, the panel discussion. The discussion brings together senior risk officials from banks to share their perspectives on the theme implementing RBI's ECL regime, strategic trade-offs, governance, and operational resilience. Our esteemed panel will reflect on the practical challenges, readiness frameworks, and the governance imperatives associated with the transition to the ECL regime. May I now invite the panel members on stage. Shri Ravindra Singh Negi, Chief Risk Officer, Bank of Baroda. Can we have a huge round of applause for our dynamic panel, please? Shri Vasudeva Konda, Head Market Risk, ICICI Bank. Yeah, we should welcome them with a huge round of applause, please. Shri Sugata Nag, Senior Vice President, Head Corporate Credit Risk, Axis Bank. And Shri Nachiket Damodre, SVP Risk Department, HDFC Bank. We invite the moderator, Ms. Aruna Pannala, Partner, Deloitte. Ma'am, please. Yeah, with that, I request the moderator to take it ahead. Thank you.
Thank you. Thank you all for being on the panel. I'm sure you will find it fascinating. For a day well spent on ECL and related topics, nothing can be better than having the practical experience of people who've thought about it, lived it, worked on it, and also possibly guided the hand of the supervisor. So thank you very much for being on the panel and agreeing to be questioned by me. A few questions, but the way we will pace this is, I have a few questions, but we'll leave it to the audience to ask some questions as well and learn really from the practical experience that all of you hold. So, sir, we'll start with you. After a day-long sessions on ECL and what it could mean and how we need to address some of the challenges around it, what do you see as the potential impact that ECL framework adoption of that will bring to the industry at large?
So first of all, thanks IBA, Bhagat Saab, Goyal Saab for inviting me over here. This is one of the thing which we are looking for. What kind of changes it will bring? Will we adjust to the new normal? Because this is the challenge for all of us. And if a challenge is for all of us, then really is a challenge. So because all of us actually adjust to that. But all of us know that the provisioning requirement is going to go up, and therefore the credit cost will go up. How do you then adjust to it? So right now with the reference rate, you add a spread, you add a credit spread to it, and you are going to add to it. And then on the other side is your competition which pulls it down. So you have to fight a competition at the marketplace, be it a home loan, corporate loan, the spreads, the competition will always pull it down. But other side is the reality that basis your portfolio quality, there is a PD, there is an LGD, and you're going to come with the spread. So how much of it the bank is going to absorb, how much of it bank is going to pass, that only future will tell. But at the moment, the changes which you see and which I see, a lot of discipline will come. So in terms of we know if an asset moves from stage 1 to 2, it's going to have a huge implication in terms of the cost. Now, can you pass on that cost to the borrower, or should you absorb that cost? So there are going to be a very big challenge before the bank. The second is on the customer side also, you will see a lot of discipline may come back. In terms of nobody would want to be seen as a high cost and low quality sort of things. And we have seen in terms of when we had this kind of credit information bureau companies coming out with the scores, and all of us are very careful since then. So previously, you might not have cared about your scores or your credit profile, but you know that if you miss a payment, it is going to have implication on that, and then it is going to cost you. So you are more disciplined. And similarly, on the customer side, this will bring many discipline. On the banker's side, we'll be more closely watching our portfolio and we would not want that our actually stage 1 slips to stage 2. So a lot of discipline actually coming back. But the cost implication, only time will tell as to when we adjust to it and how much we adjust to it. But that sort of volatility will be there, and time will only tell. But all of us actually have been calculating those impacts for so many years. It's not a new thing. And all of us know about the numbers, maybe slightly here and there, and maybe to be adjusted for the new guidelines. But all of us are aware. And few times back, we have heard one of the MD and CEO announcing a number, and then all of us actually jumping to our calculations that where I fall in that range, plus and minus sigma and all. So we know those numbers. It is going to have impact, but all of us, because it's a system level, I'm sure that some think banks will adjust, some will be passed on to the borrower. But at the end of the day, I think that is the new normal we need to adjust to.
So essentially, it's going to bring in a lot more systematic approach to how we're going to lend, and possibly force the hand of the customers as well to kind of act a little more disciplined manner.
Yes.
Because at the end of it is really the profitability of the banks at stake.
Right.
Sure. So Vasu, to you. Sorry, you want to add something to it?
And I'll just also add that to a certain extent, I mean, each of them are a market in its own self. While, I mean, I may say I want this particular spread to be charged on a particular client or a segment of clients, but there is
Market
a competition
realities.
that is there, and broadly based on whether we call it CIBIL score or whichever way we profile the customer, there is a price for that given in the market. So while definitely there is a little more understanding at a maybe branch level or a granular level within the organization, how it would impact the pricing ultimately is something, I mean.
Yeah, whether we'll pass it on to the customer or not is a competitive issue, but at least it'll bring in a lot more discipline in terms of how we're going to be looking at it more closely and understand the variance, if anything.
Or relative choice between a set of customer versus another set of customers, that becomes much more
A deliberate issue.
understood at the granular level. While I'm reasonably sure it is there currently also, it will probably become
More
much
accentuated.
more,
Sure.
stark.
Sure. Now, let me ask a question, a few only. The ECL models, we talked about different kind of levels of sophistication. But the heart of it is actually to bring in a lot more clarity into how and what will be the provision really about. So in this balance between complexity and clarity and the need for clarity, where do you think the penny will drop with respect to how the industry is going to look at? What would be your sense in terms of the direction?
I'll just draw a parallel with the capital guidelines. I mean, if we remember Basel I, Basel II, and Basel III 3.5, if you were to look at it, probably what we are currently doing in for provisioning is equivalent to Basel I, which is same set of 0.4% irrespective of the risk category that we would need to provide. From that type of a provisioning requirement, probably we are moving directly to Basel III 3.5, where it's almost like an IRB based, which is internal risk estimate based provisioning that we are moving to.
Sure.
So in Basel thing, I mean, we probably understand the complexity that is involved moving from standardized, the original Basel I versus IRB type of regime. So that said, at a conceptual level, it's a reasonably simple concept, risk-based provisioning. So depending upon how you have seen the risk play out in your own entity, you make the provision.
Sure.
That said, I mean, it comes down to...
If only life was so simple.
Yeah. It comes down to how it is implemented.
Yeah.
Then one more thing probably we have to keep in mind, it came across in multiple times during the today's presentations. ECL at the end of the day is a estimate. It is a management's estimate of provision agreed upon between management, auditors, and the regulator, aided by models. Right? So the thing that we need to keep in mind is that models are inherent in the process, and it also has to be, there has to be some sort of an agreement between management, auditor, and the supervisor for the entity, specific entity. So that probably brings the complexity into the process. To a certain extent, it would depend upon the amount of data, the maturity of the organization in terms of ability to implement these things also will influence the expectations from each of the three stakeholders that I have mentioned. So if, let's say, scale is small, products are few, maybe context like a smaller NBFC, the ECL models or ECL process is likely to be very simple.
Much simple.
Whereas if you are across multiple products doing, a little more segmented lending and across geographies, the expectations from the regulator and auditors are likely to be a lot more. So it depends upon what are the expectations that come on to the entity from auditors and regulators. Depending upon the technology that you have, data that you have, complexity that you have, that brings the complexity.
So much like the ICAP, where they say, proportionality, scale, based on scale and complexity of the operations. And that same thing is expected to play out here as well. And when large organizations find it, tend to use judgmental models, maybe that's going to be a lot more challenged by the stakeholders that you mentioned than when you are able to demonstrate it as a much smaller bank. But that brings me to you, Sugata, which is, much has been spoken, I think rightfully so, the macroeconomic model overlay on your ECL estimates, right? And that in itself brings, forget complexity, challenge, because it kind of brings in a lot more volatility. Do you want to talk about how some of this can be addressed in the earlier sessions as well? It's been discussed a little bit, but maybe you want to talk about it from your perspective on what does macroeconomic model overlay on ECL estimates? What does it bring to the table, and how do we deal with some of the challenges around it?
So I'll try to answer this question. It is not a very easy answer, so to say. I'll try to kind of maybe mention few approaches we tried and some didn't work or whatever. So in my view, there are primarily two kinds of challenges on macroeconomic modeling. The first is that what is the relationship with the macroeconomic modeling to the default rate, or for that matter, even recovery or any of the other metrics that could be there. The other element is about the forecast. So the first part, if I look at it, if I look back at our journey when we started, when we said that, obviously it's very intuitive that if economy is not doing well, my borrowers' default rates will go up. So when we started doing the modeling at an overall portfolio level, and it did turn up to be significant, right? And but then we said that now when we start applying, what happens? I can't apply common PD across my portfolio, so I have to start using the PDs at individual rating levels. And when we started looking at the same approach at individual rating levels, the relationship breaks down. So you realize that that relationship that holds at a portfolio level no longer holds at, say, individual rating levels. So we kept at it. At some point in time, we found some relationship that seemed to work. So we are very happy, like, okay, I think in that particular year during the ICAP or something, we probably tried to use that also and say, okay, this is what kind of losses we might expect to see. But when we tried to do the same thing next year, we realized that the relationship no longer holds. Because if you realize that the complexity of the various macroeconomic factors that impact your borrowers' default rates are many.
Huge.
It could be differing by industry, it could be differing by location. It differs by where the borrower stands, like maybe how well capitalized is that borrower. It could depend on too many other very, what should I say, idiosyncratic factors. If I really look at also subsequently, now that we have seen a much longer period from when we started this journey, a lot more is explained by idiosyncratic factors than the macroeconomy itself. If we look at some of the worst default rate periods that we have seen in our banking system, 2017-18, to some extent 2016 as well, it was driven by AQR primarily and the fact that, say, some of the resolution mechanisms got withdrawn. It was also dependent on the fact that say, some of the very disruptive events happened, like you had the coal block deallocation, you had the 2G scam. Some of the things
Very
are
specific
completely
to the sector, unexpected.
Yeah, so which brings me to the second part about the forecasting. Now, while in theory, if I want to now do a model, I can put say a dummy for some of these events, the fundamental problem I'll have is that I can't forecast such events. I can't say that when the next such event will happen.
Unpredictability is becoming a...
Which is what will make the macroeconomic factors very, very challenging. So one approach that we have tried to take, and I can't say that this will necessarily work or not, but see, there are, again, when you look at, we use PDs starting from ratings. So ratings, there can be two different philosophies on ratings. One is which is a through the cycle approach, and the other is a point-in-time approach. In a point-in-time approach for the rating system, not the PD, I'm talking about the rating system itself, you are expecting that you are trying to factor in all that you know in the rating information at that point in time. And when you're doing that, one advantage is that you are no longer restricted to a set of macroeconomic factors that you want to model. You can now go back to this specific borrower and say that what really is happening with this borrower. While our borrowers could be exuberant at times compared to our lenders, but they definitely know their businesses better than we do. So that borrower may actually give us some information which might give us a better insight about how the next year or the next few years might play out than any kind of a macroeconomic modeling that we can put in. So if we try to factor that into the rating itself, that in our view is probably a better approach. Like you basically embed the macroeconomic factors or other such factors into the rating model itself, rather or the rating outcome itself, rather than trying to put it as an overlay.
As an overlay. Okay.
So in our view, that is an approach that we are trying to work with.
Is
I
that
don't know how it
something
will
that will
work.
be acceptable across the board with the stakeholders that Vasu mentioned?
I don't know. My sense is that there's an expectation that there is an overlay kind of a thing. But we'll have to see how do we...
It almost is like you need to take the stakeholders with you in this journey of how you're thinking about it, get them comfortable with this to ensure that the risks associated with what run model have been factored in, as opposed to there's a regimented way of doing this. Nachiket, to you, really.
See, one important aspect about macro forecast is that whatever forecast we are getting from wherever we are getting, finally, who is accountable for those forecasts? Because the inherent bias that is created in the ECL because of these forecasts, I'm predicting some ECL number today. The ECL turns out to be something else going forward. The accountability of forecast is very important, which is not talked about today. We assume that the forecast coming out of the source is sacrosanct, and we're going to use it. So that is something that even we are trying to understand. And in fact, macro modeling is always a roller coaster ride, according to me. It's like someone who does a PhD, and one particular morning he gets a eureka moment, and next day he's down, sunken, because that doesn't work. It's something similar. So we tried a lot of, as Jatin mentioned, transformations on the input variables, transformations on the output variables, trying to fit, and we possibly end up over-engineering stuff. That is something, and we don't know where to stop. So that is something that we have to pay close attention to. What we're trying to achieve. Do we want a parsimonious model, few variables, trying to explain it broadly and not really to the decimal point, but broadly, having some intuitiveness to it, where it can be easily explained, and possibly, we have to defend that model of ours in front of validators and aggressors much more vehemently than a complex model where a lot of PhD can be put out there and put it that way. But personally, I feel it is the simple, parsimonious model, which is intuitive, that can go a long way.
While that can be said of the models, about the data, we have to be precisely right. So how do you look at getting the data right, both in terms of ensuring that it is good quality, but also demonstrating that it's good quality as well? How do you kind of ensure a good data quality framework?
See, data has been talked by everyone since morning, so there is no point in belaboring it so much, but it cannot be stressed enough. It definitely cannot be stressed enough. Everyone knows that the models are only as good as what data gets into the models. I think at the heart of it, what I feel is, it's a journey. At the heart of it, having data ownership. Who owns this data in the bank is very important. Those kind of policies have to be established. Because in this journey, a lot of data getting created. It could be the original data from the source, it could be transformed data, so on and so forth. So in that journey, who owns that data at what stage is very important. And it goes without saying that the tone from the top is very important over here. Data quality is something that is picking up. Data KPIs are being created. Data shifts are being monitored. But all those things then have to be elevated in the discussions at executive committee levels, at board levels, to appropriately warrant them the right kind of attention they need, and fix accountability at the right place to ensure that data gaps are covered. There's a feedback that's continuously monitoring that data and ensuring that the model is finally using the right data that is needed.
Just wanted to add on, actually build on that. So right now we are used to, like, for example, 0.4 for X borrower. And across for these bank, if suppose the same borrower, the ECL is going to be different for the same borrower, and assume that everything is there. The quality of the your collateral is same and the borrower is same. So the probability of default and associated on a theoretical level may be same. But because the data, as you rightly said, for example, the GDP data, if the asset correlation with that you find fit, but the data quality, who gives that data? And across economists also, you will see the GDP forecast varies. Across IMF, Government of India, RBI, who gives those data points? And different bank actually relying on data points, but everything else is same. The borrower is same, the quality of collateral is same, but the ECL is different. And therefore, it also somewhere impacts the competitiveness of the particular bank. So for example, I got an ECL of say 40 basis points, somebody might get 90 basis points. Does it impact the competitiveness? The answer is yes, it will impact, because finally you need to actually debit your PL and you need to provide for that. So, so there are challenges, and over a period of time, I think as we learn, we evolve, and then sort of like we'll converge to a point where the variability between the banks is not much. So this is one of the prime challenge which I see.
Sure. So in this bargain, getting the data right and able to show to all the stakeholders that you're using the right set of data becomes an imperative almost to the ECL calculations. One is the different sources of information that you might get it from, but whatever be the source, especially the ones that are internal, having the golden data becomes a critical part of it.
Data and the traceability of that data.
Traceability of that data. So Vasu, switching the gears and just talking to you about the role that you played as well in the last 12 to 18 months. What might be some of the, in your view, what might be some of the considerations from a regulatory standpoint, regulator's mindset, in introducing this at this time for the banks for adoption? It's like the winter's coming, right? We've always been waiting for it, and here we possibly are turning the page. So what might have been some of the things that...
Difficult to say, but I mean, 2018 NBFCs went with the Ind AS, and probably, I mean, RBI could have thought banking system is a little more complex and might go a little later. I mean, that could have been the initial thought. If I remember, there was a Ind AS committee also of the banks, chaired by RBI team, and they came out with a detailed report. So somewhere, I mean, the process was there. Maybe COVID would have disrupted that thought, and maybe the subsequent, I mean, the COVID effects, and I mean, maybe that would have taken its own time for the things to, the COVID effects to go on. Maybe the profitability in the banking, overall banking system seems to be reasonably good, and probably this is the right time. I mean, because they, at various points in time, RBI was in touch with this concept. It's not that in the last 8 years, because the original Ind AS committee and subsequently maybe in 22, late 22 or early 23, they came out with a discussion paper. Then there was a internal committee, and finally, so I mean, they have probably been conscious about.
So ECL has been lingering on for a while now.
I guess, yeah. It's there, and
we were
have
hoping to
anyway,
see if you were going to give us some inside track of it, but.
No, the committee also, I mean, the discussions were broadly on the lines of that it is an imperative. I mean, we need to bring it at sooner than later.
Sure.
That was the thought. And what would be an appropriate time from absorbability? There is a sense that it probably will have
stronger balance sheets are required to
impact on the provisioning at a larger system. So
So now can we expect that the dates that have been mentioned, 2027, will be the date, or do you expect any more? Or it's anybody's guess at this point? Reasonable degree of certainty.
The way the regulator has been mentioning in any of the forums is that this is the guideline and we better be ready with the implementation and move on.
Sure.
Maybe there may be some changes in the final print versus the draft guideline.
But largely this is where
largely
it's there. Sure. Thank you. You kind of sidestepped very nicely, but thank you for that. Sir, for you, because it's been a concept in the coming for some time now, and almost everybody has worked, has understood, has poured into those documents, delved into their data, and made some models, right? So how do you rate the level of preparedness getting into this? And also, do you think the implementation timelines are realistic in that sense?
So not only us, all the banks, I think entire banking system has been preparing for this for last so many years. And one thing it did actually, it educated us, and in terms of like stress testing those numbers and looking at those numbers. So we know about this for quite some time. And I think the preparedness on this front has been there, and the only thing which banks are now doing is the gap analysis in terms of, for example, when you ask LGD number itself to adjust for the macroeconomic variables, or you sort of like give a scenario sort of thing. So we have been preparing for the best of the time, or maybe normal time, as we see the concept of Viksit Bharat 2047, and it's still India's economy being one of the fastest growing. And those numbers reflect very good on the economy part. And once you project PD numbers and other numbers, they look good. I mean, you can manage them well. And that is where the India is going to go. But then the guidelines come and they say it's not about the best time, it is not about the worst time, it is not about the normal times, but it is average of all of them. And you will have to have those scenarios. Now, you need to go back, you need to work on those assumptions actually and see what sort of weightage you give to these kind of like 3 broad scenarios and what sort of assumption you have, what sort of framework you will have in place. Because at each point of time, so you can't claim that you have 100% in place. Even if you claim that, once the RBI comes for the examination or the auditors come, they are going to challenge it. And you will have those challenges. And therefore, it will evolve over a period of time. So we'll learn from our own mistakes, the good things that our competitors are doing, the banking industry, and the kind of seminar which the IBA has organized. We are going to learn and adjust to ourselves to this new normal. So that is where actually, again, we have to go back. And as we see, last time it was being discussed at the IBA Risk Management Committee. Sir was there, Bhagat sir was there, and we had a discussion that can we request RBI to have a kind of like parallel time to, so that we adjust to this. Because again, linked to this is the disclosure, for example. And if one point of time you ask all of us to disclose, it might have impact on the share prices of the bank, for example, because you have not seen enough to the new reality, you have not seen the numbers of other competitors. Yeah. And as I said, for X quality of a borrower, I will have a different ECL number, you will have a different ECL numbers. And therefore, you disclose that. So for example, you might disclose that your ECL number is 0.5, somebody might disclose 2%. And the investor community is going to definitely ask your MD and CEO, your top management, how that differs and what is your assumption, why it is not equivalent to your peer banks. And this is one of the challenge, and therefore, a glide path to actually adopt that, even to the disclosure, and that has been requested. But even if that is not given, I think bank will be ready. Sure. The only pitfalls are there that you will learn when it evolves over a period of time, maybe next 3, 4, 5 years, when this best practices, they converge, and we come to a range where the volatility between banks is not much. Sure. And I'm talking about when the quality of the collateral to a borrower and borrower is same across banks. I'm talking to that point that the volatility should not be there. Otherwise, it might so happen that one bank has 0.5, whereas another bank might have 2%. So it's basis the mathematics, the logic, the assumption, the feed which you give, and it goes to as low as GDP data. So which data you take up?
Sure. So basically what you're saying is it's not just about preparedness, is not about just switching on the lights, but it's also about how you're going to keep refining so that you're able to establish the comparability and are comfortable, therefore, in stating what you state to the general public at large. So that, for you, preparedness is not just 2027, but unless you're all very mature in what you're able to discuss openly as well. Okay. Sorry.
I'll just give a parallel. Most of us would have gone through house construction. The coca gets ready in very quick time. We think, lots of, we are very close to completion. But that last 10% would take a reasonable time. It's like we all prepare pro forma numbers. We have the broad concept ready. Broad numbers are ready. But moving from that pro forma to a full governance-based numbers after tying in the last loose end is a significant challenge.
Yeah.
And lot of times, if you remember, you would have in your mind decided, okay, I have to move into the house this time. Irrespective of whether it is complete or not, I will complete it after I move in.
Yeah.
So most likely some of the things are going to be that.
This is so well said. This is like housewarming ceremonies. All he's saying that celebrate it, but you will keep refining and make it livable
keep on,
as you
keep on changing, moving, improving things.
I've heard many things about ECL, but not a housewarming analogy. But this is interesting. So Nachiket, to you, we talked about educating the stakeholders, taking them along, but clearly from the circular as well, it's CRO, CFO, working together. But there's a lot more in terms of who all needs to be taken through this journey. So how are you thinking about this, and what should we focus on?
So on something that is so cross-cutting, cross functions as ECL, we cannot say that the accountability and awareness only sits with the modeling team or the finance team. This is actually an overall, the way I look at it is that ECL is finally the manifestation of right from credit strategy to credit risk management practices, collections and whatnot. Everything comes together finally in the form of a number, which is the ECL number. So it is all pervasive. And that is why the various stakeholders involved across the board, it is very important that we start socializing the ECL way of things now with all those stakeholders. And while we have started the activity at our end, you'll be surprised that when my team of modelers wants to go across and sit, say with collections team, or how very difficult it is to explain these concepts to them. It has to be simplified in a manner which actually pinpoints where they are likely to be held as stakeholders, what is important for them to be held accountable for. So the socializing aspect which is there, it could be at the level of business, at the level of businesses, collections team, business finance teams, the policy people. So all that socializing is very, very important across the bank. But all the more what is important is that the executive committees, the CXOs, CROs, they start talking language of ECL. They have to inculcate that language, those paradigms in their day-to-day transactions, be it risk appetite, capital. When all that thing is settling down, it will help for that kind of information to pass through and understand the importance and where ECL actually strikes. So at ground level, yes, we've started the work of socializing thing, but also we are enforcing policies and from the top.
So you are inviting a lot more guests to the housewarming ceremony.
Yes.
And also letting them know that this art is going to get perfected as we go along.
As we go along.
Right? I think these models, these estimates, these overlays, we'll work with a whole bunch of them and a whole bunch of new controls that we'll institute, but it'll take time to kind of get this.
So as he rightly mentioned, it's a long tail. Tail is very, very long. So during that long tail, there's bound to be evolution in the way we do our modeling. The techniques will change. And that will be another reason for volatility, which Jatin pointed out some few reasons for volatility, but this is also an important reason. As we evolve our technique, as we learn new things, how do we accommodate that in our numbers and yet manage the volatility of P&L? So that's going to be a long tail to take on.
Sugata, to you, I think modeling is all about finding that nuanced position, nuanced outcome for a particular segment. But floors and caps, they kind of blunt it. So just want to understand from the heart of not the mind of a modeler, but the heart of a modeler, what does floors and caps mean to you? And maybe then you can also talk about it in terms of ECL.
See, I mean, when you were doing the modeling, I don't think you were paying so much attention to the floors or the caps. And I'm not just looking at ECL, for example, when say we move to IRB, or we applied for IRB, that process anyway is kind of, it's got nowhere, so to say. But nevertheless, see, when we are going through that process, what we essentially said that we are doing something because we are wanting to manage our portfolio, which want to manage our risk in that portfolio. So your objective is to kind of capture that risk appropriately. It is incidental that in case of IRB, it would have got used in, say, capital computation, or in case of ECL, it might go into a provisioning.
Okay.
But from a risk standpoint, at least I would say that you are essentially trying to as closely replicate the behavior of your portfolio. So the caps and floor may not be what really will influence that decision, in my view.
Sure. So the purpose for which you're developing the models triumphs over what it might eventually also be used for.
Correct. Correct.
And so the ethos is going to remain.
Yeah. And I mean, of course, there could be some additional challenges which we might figure out as we go along the journey. I don't yet know, because very clearly it is one of those things that will keep evolving. And it's not as if that, I mean, day one, we are kind of fully ready. It's probably one thing where you are never ready for it, so to say. It's something that we will keep learning. We will, because in this particular case, what will also happen is that there will be impacts coming from the business, the way we perceive it. This is probably one of the biggest impact the business will directly face from what we do. So there, I mean, one conversation about, okay, there's a feedback from the ground that this model is not working or something like that.
Sure.
I mean, we do face it today also, but I guess that some of those could go up going ahead because it directly
It kind of
impacts their
impacts,
business.
yeah.
So those things will be there, but I think less to do with the caps or the floors is what I feel.
Understand. Just on the topic of disclosures, and we did talk about it, and the auditors, there are a number of regimes that have already adopted ECL in the past. So ECL or the variants of that. So any lessons that any of you, all of you would want to comment on that we can learn and move forward. By the way, this is my last question, so please be prepared with your list of questions that we can open up the floor to.
From my experience with the US GAAP auditors, because we are on the US GAAP auditing, one thing that could be seen is we have a run up to the implementation, about a year or so. But I think this time should be taken to plan early engagements with the auditors. Right? That gives us enough time to understand what the expectations are and appropriately fine-tune our stuff. So this part is important that we start engaging with them early. The US GAAP audit has also, a lot of focus has been on controls. So the control operator, the kind of evidences the control operator has to show that the control was indeed operated in a particular manner. All those things are very important. So a SOX framework along with this will always come together finally. Yeah, generally judgments, post-model adjustments, like we discussed, all those come under significant scrutiny. Significant scrutiny from the auditors.
So we simply can't say that this is, the model is not holding up, so let me just add a buffer, unless we're able to explain it, unless we're able to, fair enough.
As a banking system, we are used to actually adjust to the volatility, and so many banks, like you will see, completing 100+ years, first they have seen so many cycles actually. The volatility is not new to the banking system. So whether it is in terms of like provisioning or testing your capital adequacy. So we have gone through a number of cycles in the past, and every time we came successfully out. I'm sure today, whatever assumptions we have with regard to volatility, we'll definitely adjust to new normals. And when again, maybe 1 year after, 2 years after, and when we meet, again, we can backtest our assumptions, which we are making today, and then we might conclude, oh, we were wrong, and we could adjust. So I feel to this new reality, because this is applicable to the entire financial system, banking system, and all of us are sailing in the same boat.
Sure.
We will adjust to this new reality, and I think things will come back again. As I said, the spread is again, the competition actually pulls it down. ECL might actually take it up. But then where does it adjust? It will adjust to that new normal. All of us will be part of that. And I think banks will be much stronger because this brings a lot of transparency. Sure. This brings a lot of discipline in terms of like you're monitoring your exposures, in terms of customer actually checking their profile and sharing information. So I think that will add to the strength of the banking system.
Sure. Thank you. Any final thoughts?
When it comes to disclosures, I think it will evolve. If you think about even currently also, there is some basic requirement from accounting standard all of us will publish. In addition, if you see, there is also a presentation that most banks put out along with the financial
with the numbers.
That's not mandatory. But yet, all banks put out an additional information which has evolved. So to start with, that information might have been much smaller. But over a period, based on market demands or how other entities have published and what is perceived to be good practice, they will evolve, and the disclosures will also evolve along with that.
Sure.
To start with, I think whatever, bare minimum are required as per RBI, that would be there. But
MVP is what we'll deliver to first and then see where this goes, yeah? Sugata, anything from you?
No. Not so much on the disclosure part, but I think one of the key stakeholders which we will find very difficult to invite to the housewarming parties the share investors, because I don't really know how they are likely to perceive these numbers. The first time we'll be seeing it, the first time we'll be seeing the kind of volatility. And ECL numbers will be definitely way more volatile than what we have ever seen in the past. And some of them will be very difficult to explain. The numbers change because I recalibrated the model. The number changed because we rolled out a new model. These are very difficult to explain. I mean, if it is explained by the portfolio, these are far easier conversations that we can have today.
Yeah.
This quarter, my credit cost went up. Okay, I had slippage in this portfolio. But this is going to be much more difficult. I mean, it may not always be that I'm expecting more slippage in this particular portfolio. It might simply be I recalibrated the model or I introduced a new version of the model. And maybe at that point in time, we might actually thank the regulator for the floors.
There you go. I think very few occasions where we're actually thanking the regulator. So great note to end this one, but thank you very much. Any questions from the audience? Anyone?
Yeah, good evening. Thank you all the panelists for such a wonderful session on this. So my question is to Negi sir. So you spoke about the competitiveness among the banks because the variance in the ECL figure arrived based on different models. So my question is that we have different factors affecting the ECL. One is that external and one is internal. So external, in most of the cases, it will be same across the models. But at the same time, if you see the internal factors like LGD and EAD, that is based on your data for the last 5 years or for the 10 years. So that your competitiveness will be purely based on your internal data. So, and if you have a bad EAD or LGD internally, again, that will further deteriorate your competitiveness. So, and if you go for a fresh sanctioning, then you are no more competitive because of your existing data. So how are you going to deal with that kind of situation?
The external factors, so like one of the things, when you are asked to give the weightage, for example, worst scenario, best scenario, normal scenario. So you have 3 scenarios. And I end up giving weightage of, say, to the worst scenario, 10% weightage. He might give his 20%, he might give 30%. You know, so that is going to reflect in your ECL numbers. And ECL is a spread which you are supposed to add to your reference rate. And therefore, as an institution, you are in a dilemma. So competitor, for example, I am able to offer a better deal to my customer, whether he will be able to offer. So you'll have to sacrifice while debiting his PL for the provision. But then again, to meet the competition, he will have to bring it down. So when it goes to his credit committee, he will be questioned. And he will say, this is the market rate, this is what actually Bank of Baroda is offering. So in medium term, I'm not saying in a long term, because all of us will adjust to this reality. All of us will learn through each other. And then we'll adjust. This will converge. But when it is a starting point, I mean, there may be divergence between the banks. And I was talking about that point. But long term, when we adjust to this, when the best practices evolve, you're right. This will be internally driven. And probably then all of us will be slightly here and there, but more of a kind of like standardized things in the marketplace.
Let me clarify to all of you whatever you are asking, and Mr. Negi has given the purpose of this seminar also, because it is a new concept. We want to create a such ecosystem that one bank should not say because they have used the another model, another system also. This is the reason provisional requirement is coming more or less also. The purpose of this seminar is only we have to see which type of the model for which type of the product they are saying. So we should be in a position to make the right provision based on the credit portfolio of the bank. On account of the, I think, introduction of the ECL, the risk management department will be very mindful of the different banks, which type of the exposure they are taking. This is the purpose of the meeting, and Mr. Negi has told, initial stage, there may be some issues, but longer run, the ecosystems should be like this. Nobody should tell you, because you have used this model, that should not be the purpose of this seminar. The purpose of the seminar, we have to create such type of this. This is the reason we are asking which type of the model we should adopt within the country in the banking sector. This is my take.
Sorry.
Yeah, Negi ji and others, of course, very, really, it was knowledge sharing and, thought-provoking. Just one aspect I still want to really understand from expectation only. Will there be a trade-off between growth and good quality of credit assets?
So, in my opinion, I mean, there will be still stronger competition, sir, for the better quality assets, because all of us want better quality, lower provision, and all of us want better RAROCs, and therefore competition will still intensify. And that's why I said the ECL number which you provide for and what you charge customers will, to a large extent, will also depend on competition, because it is going to pull it down for better quality. Of course, when the quality goes down, I mean, you will have that comfort level. But on a better quality asset, there is going to be a tough competition. And all of us know the better quality in terms of corporate, MSME, be it agriculture and all. So all of us are after those borrowers. And in today's world, where the information is, all of us have that information, which are those quality borrowers. And all of us are after them. And when it comes to ECL, again, the competition will only intensify.
What I feel is there could be some shakiness in the beginning, but over time, the credit risk management practices itself will be refined in such a manner internally in the banks that there will be scope to continue with good growth and at credit quality which can be managed, which can be mitigated, which can be managed. That kind of maturity will come because that's how the process is going to evolve over time, is what my perspective is.
You have to charge the premium also, basically. It is a matter of which type of the risk. Risk is not a chance, it is a choice. If you want to take the risk also, you have to charge the high rate of interest. RAROC is the main issue, which is not, because as of date, the rate of interest in the market remains. But tomorrow, if you are going to ECL, implement the ECL, etc., also definitely you have to see whether you are gaining from this transaction or not. You can take this, but you have to charge from the customer also which type of risk you are taking.
Yeah, something very similar I would echo. If you look at the overall system level, sir, the number of customers asking for credit is not going to be very different. The number of people who will default at some point in future also is not going to be different. So it is at an individual bank level, we start to understand, differentiate between types of customers. That sensitivity will increase. Probably right now, we are subsidizing the weaker customers with at the cost of the better customers. Probably the sensitivity will be, or there will be a better understanding of who are the better customers, who are the weaker customers, who should I charge less, who should I charge more. That understanding may improve over the period of time, and the pricing may change. But at the overall system level, that demand and demand for credit and who will go bust, who will default is independent of what banking system will do. So there is a probably a better understanding of who's a better customer and who's a weaker customer. That will evolve over a period of time is the way I see.
And just adding to that point, sir, the growth you talked about, so this comes also from the size of the pie. So in India, you will see the size of the pie is actually continuously expanding. The aspirations of the people in young India, the median age being at 28 plus. So you will see this is aspirational India, and a lot of urbanization is happening. And that's why you will see the house prices, particularly in Mumbai and other cities, you will see. So you will not find them coming down. And people are affording. So when I joined the bank, the first thing if you can afford a motorcycle, for example. Now today, youngsters, when they join the bank, they come to the bank with an SUV. So their affordability has dramatically gone up. So, and you can compare, all of you at whatever age, you can compare when you joined, and you compare yourself to the current youngster. He has a lot of aspirations. He has a latest SUV in hand, and he purchases home. So this size of the pie is increasing, and therefore the growth will naturally come. And this will only give us competitive advantage in terms of like chasing those borrowers. So growth is surely there for us, sir.
Even I agree with the Vasudeva also, because if you see the case of the, because it has to be implemented in the bank, 2027. See, take the example of the NBFCs, na? Right. They are already calculating the ECL. I think 2018 they have started the IFRS, which is the part of, it is a part of the IFRS basically. Is the Mr. Banerjee was saying definitely we are not going in one go. We are going investment already done. So NBFC, they are also doing which type of the customer they are taking, which type of the rate of interest they are charging, whatever the collection cost. Basically, if you see the collection cost of the NBFC, normally between the 5 to 6%. This is the reason they are charging high rate of interest. So they are taking risk also. And which type of the customer they are financing, to whom the banking sector, even the customer is not bad or good, it is not, but they don't have this type of document, etc. also. And NBFC is doing, because they have the model also. Even the cash flow based lending has been started by the bank also, where they don't asking any document. I agree with you. It is not a new as on date for the financial ecosystem, because it is being used by the NBFCs.
So a question from me.
Yes, sir.
See, we always have been challenged, how do we price for our risk? Bankers, there's always a challenge, how do you price for your risk? So you say, on one side you see the risk which is inherent in the proposal, on the other side you have the market. You have to compete also. How does this ECL change this system? Or are we in the same way like we are working together? You will know your ECL, you will know the risk more particularly, you still have your market competition. How do you resolve that, any one of you?
Yeah, so just a very quick reaction. So even if we have the floors across the rating rates, and that is a general provision, for example, 0.4, so that is for sure you are going to provide, and then you have your PD LGD numbers. So that is going to stay there. How much concession you are going to give there? You can't make the, for example, the credit spread to zero. I mean, it is only the sovereign prerogative where they can get zero. Even if it is 1 basis point, 2 basis points, so for a top rated borrower, for example, you charge 1 basis point, whatever be the competition, very heightened competition level, it can't be zero, so 1 basis point. Next stage, you are going to charge 2 basis point, 3 basis point, 4 basis, or it will exponentially go up. So what I mean to say, whatever competition brings down, still you have that credit risk pricing. Now, how much competition brings it down, and how much ECL pushes it up? I mean, it is interplay between these two, and only when we evolve and when the competition, only then we'll come to know about it.
Everybody will factor that, which is not being factored as of date.
Sir, if you look at it, any pricing decision, broadly 3-4 components that all of us look at it. There is a funding cost, funding deposit, whatever, funds cost. Then there is a credit related cost coming from ECL. Then there is operations cost. Each of us have our own branch or that operations cost. All banks at the end of the day have different levels of these things. Right now, it's not that all banks have same funding cost. They all have different funding costs. They all have different operations costs. But the final lending rate to the customer is the same by all banks. When they are lending in a consortium, or they are all very close to each other. So, as I said earlier, there is a market for customers pricing. That will have its own manner that will move along with the systemic factor, demand, supply, various other things. These also become an additional factor. It's just that banks will have a better awareness of who are better customers, who are weaker customers, who should be relatively charged higher compared to other set of customers. That will start to become. But at the overall level, I don't think too much of a change will happen. That's the way I look at it.
There is only one more element which we generally forget is that the return on capital component itself. In my view, the return on capital component contribution to the pricing is much bigger than the contribution from the expected loss. This is what my view is, what I have seen generally. While I'm just saying for the perspective, like our businesses would come back and argue with us that ये rating क्यों दिया है, मेरा expected loss ज़्यादा हो रहा है or something like that. But that hardly moves the needle. I shouldn't say hardly moves the needle. That moves the needle much less than the capital component. The capital component moves the needle much more. So, I mean, unless people are cognizant of that if there is a mispricing today, that might be slightly reduced because everybody at least is forced to kind of make provisions as per ECL. But unless people acknowledge the fact that the capital component makes a much bigger impact, that mispricing might continue to happen.
Okay, thank you very much. I think in closing remarks, and I wanted to offer my perspective as well on this, but 3 things are going to definitely happen. One, risk managers are going to think more about business and business is going to think more about risk. Second, credit strategy is going to be more responsive to what they expect to happen in the future than just look at market opportunities. Because ECL and the data is there, it's showing you information. Pricing may be a much later in the day, but at least credit strategy, who you want to go after might change. The third is that there is going to be some discipline, some more discipline on once an account becomes a PD, a default, what do we do about the collections? This is controllable factors. So we will focus a lot more on the controllable factors and see where that leads us. But my one takeaway, I came in thinking ECL is coming, but I'm going away thinking ECL is evolving. Thank you very much for this. Really appreciate this. Thank you very much for the audience. Yeah.
Thank you very much to the panelists and to the moderator. Wonderfully navigated our discussion, and it was very enriching and engaging discussion. May I now invite Shri, sir, please be on the stage for a moment. May I now invite Shri A.K. Goel, Chief Executive IBA, to kindly present a memento to our panelists and the moderator as a token of our gratitude. I would like to request you for a group photograph, please. See, sir, please join. And may I request Deputy Chief Executive, sir, Shri Gopal Murli Bhagat, to join us on the stage for a group photograph. And Shri Jay Shankar, sir, Senior Advisor, CIB, for a group photograph. Thank you very much, everyone. So, ladies and gentlemen, we come to the closing of today's program now. It is my privilege to invite Mr. S. Jayashankar, Senior Advisor, Corporate and International Banking, Indian Banks Association, to deliver the vote of thanks and conclude the proceedings. Over to you, sir.
Before Jayashankar ji give the vote of thanks, from my side as the Chief of the IBA, I place on the record my sincere appreciation, thanks to the Jayashankar, Senior Advisor IBA, and his entire team also, and DC Gopal Bhagat ji also, for doing lot of work for 2 days preparation also. So really it is a wonderful, and you have done a great job. My sincerely thanks to you and your team also.
Thank you very much. Thank you very much. On behalf of the IBA, let me my heartfelt appreciation for all the participants who took the trouble of coming here at such a short notice and being with us for the whole day. I hope we have been able to add some value to your learnings on this topic. At least for me, I'm not a risk management person, so this has been a wonderful learning over the past 1 month, and today's discussions were actually brilliant for me. Let me thank the knowledge participants, Aruna from Deloitte, Rajosek from KPMG, and Jatin from GT, and the entire team which they brought. Brilliant in their own field, and the amount of time that they spent with us in curating this was just too good. Thank you once again for doing that. My thanks to the panelists. At such short notice, we told them, and because of this schedule, we couldn't even discuss with them as to what could be a probable questions or what is the way the panel has to be structured and all those kind of issues. So, but then we knew very well that their experience that they bring to their fields would help us in navigating this. A wonderful close to the today's discussion. To the IBA staff, WTC, all the vendors, thank you very much. Till yesterday evening, we were expecting only about 40-50 people kind of position, so we had only half the hall. But then overnight we knew that we are going to run away from that 50 number which I had anticipated. So we were able to bring that very beautifully into it. Thank you very much for everybody. Thank you once again. There's a high tea there. Please have it before you leave. Thank you once again.
Thank you very much, sir. Ladies and gentlemen, with this we conclude today's seminar. We appreciate the presence and participation of our dignitaries, speakers and delegates. Thank you once again, and please join us for high tea.